Nvidia. Right now, they seem absolutely unstoppable, don't they? A true titan of the whole AI revolution. But what if its entire story, that massive valuation, is actually resting on a single, really fragile assumption? Let's dig in and take a closer look.
Look, most people just watch the markets go up and down. This channel is for people who want to understand why they move. If you want to stay ahead of that curve, go ahead and subscribe.
First, let's just take a moment to absorb the scale we're talking about. Based on our analysis, Nvidia's market cap is a staggering $4.44 trillion. That's a number so huge, it's almost hard to wrap your head around. It feels like it represents the limitless, infinite potential of the AI world it's powering.
So, yeah, the market has priced this company for absolute perfection, for endless, non-stop growth. But that brings us right to the heart of the matter. What if the foundation of that entire incredible story is, well, a lot more delicate than it seems?
Okay, so first, let's look at the bull case. You gotta give it to them. It's impossible to deny that Nvidia is an absolute powerhouse. The numbers, they really do speak for themselves.
These numbers really seem to justify the hype, right? Take that forward PE ratio. It's basically a measure of the company's price against its expected future earnings. Now, a ratio of 38 might seem a little high, but it's not totally outlandish if you believe that the revenue and income are just going to keep growing at this insane pace. The market isn't just betting on a good quarter, it's betting that these numbers are the new normal, the new baseline for growth.
But here's where the story takes a really interesting turn. We all hear about the chips, the innovation, the AI supremacy, but the real story, the one that's actually holding up that entire valuation, it's about something else entirely.
This one quote just reframes everything. So forget about the technology for just a second and think about money. Specifically, who is spending all this money, why are they spending it, and what could possibly make them stop? So let's quickly define the key term we're going to be talking about here: capital expenditure, or just capex. This is simply the money that big tech companies are spending on all the physical stuff. You know, the massive data centers, the server farms, all the hardware that runs on Nvidia's chips.
And this brings us to the most crucial point of this whole explainer. Nvidia's entire growth story is built, maybe implicitly, on this one single, fragile assumption that its biggest customers, the tech giants, are just going to keep writing these massive checks for AI infrastructure year after year without ever hitting the pause button. So just how big is this spending? Well, the scale it's kind of hard to comprehend, honestly. But it is the engine, it's the rocket fuel that has powered Nvidia's incredible rise. Look at Amazon for just one example. Their capex is projected to explode from $53 billion in 2023 to nearly $132 billion by 2025. You guys, that's an $80 billion increase in spending from one single customer. This is the tidal wave that's fueling Nvidia's growth.
And, here's a quiet little paradox. We hear a lot about tech companies cutting costs with layoffs, right? And that might save them a few billion, but the real lever they can pull, it's capex. Tapping the brakes on building all that new infrastructure can save tens of billions of dollars. It is a much, much more powerful tool for managing cash flow.
For years, spending aggressively on AI was the thing to do. The market rewarded it, and as long as those stock prices were climbing, everybody just kept on dancing. But what happens when the music starts to change?
This highlights a really critical psychological shift. You see, when a company's stock is soaring, throwing massive amounts of cash at capex is hailed as strategic vision, is brilliant. But when that very same stock starts falling, all that spending is suddenly questioned. It might even be seen as reckless. And cutting back gets reframed as capital discipline or fiscal prudence. The entire psychology of spending just completely flips.
And hey, this isn't just some abstract theory. As our source points out, we're seeing this shift happen in real time. Major tech stocks like Microsoft have seen some really sharp declines from their highs. This is exactly the kind of environment where a CFO starts asking some tough questions, like, hey, can we maybe delay a few $1 billion in server upgrades this year?
So, what does this all mean for Nvidia? This is where we connect the dots, where the psychology of spending slams right into Nvidia's business model.
Here is the simple but incredibly powerful truth of the situation. No matter how amazing Nvidia's technology is,
the company does not directly control its own demand. It is completely downstream, totally dependent on budget decisions that are made in the boardrooms of its customers. Nvidia is just at the receiving end of that capex pipeline.
And this creates a really crucial distinction. Compare Nvidia to a company like Microsoft for a second. Microsoft benefits from all this deeply embedded, recurring software revenue. It's stable, it's predictable. Nvidia, on the other hand, is exposed to the much more volatile up and down cycles of corporate investment. Its fate is tied directly to how much other companies decide to spend each and every year.
And that right there, that opens the door for a massive narrative shift. If this fire hose of capex spending just slows down to a normal flow, we're not even talking about a collapse. The market could stop seeing Nvidia as this unstoppable hypergrowth company and start viewing it as a cyclical one. And cyclical companies, which have predictable ups and downs, they get valued very, very differently by investors, and usually at a much lower price. So let's bring this all together. The risk here is pretty subtle. It's not obvious. It's all about the fragility of a story that has, up until now, been priced for absolute perfection. This whole situation creates a really fascinating asymmetry. Think about it. Even as its biggest customers were announcing these record-breaking spending plans, Nvidia's stock was kind of treating sideways. What that suggests is that all that incredible good news is already priced in. It's already baked into the stock price. And when the market expects perfection, it becomes very hard to deliver a pleasant surprise, but it becomes very easy to cause a disappointment. Now, to be perfectly clear, this analysis is not arguing that AI is a fad or that it's going away. No way. The risk is much more subtle than that. It's simply that the market's story about the pace of that investment might change. The boom could just cool off into a more normal, cyclical pattern. And that leaves us with the final and most critical question. AI will absolutely continue to grow. There's no doubt about that. But can a $4 trillion valuation survive if the fire hose of capital that created it slows down to a more normal, sustainable flow? That right there is the fragile trillion-dollar bet. Most investors are going to spend the rest of the year just chasing headlines and reacting to fear. But the real edge, the real alpha, is in understanding the underlying structure of the market before it becomes common knowledge. So if you want to keep your focus on the signals that actually matter, this is where we do that.